Hi everybody, it's Ben Thompson here. Welcome to the Import-Export podcast. Today we're talking about international payments between suppliers and buyers that are shipping products around the world and how shippers can manage their foreign exchange risk in today's volatile market. Today we're joined by Rylan, who's the Vice President of Foreign Exchange at Airwallex. Airwallex have built a platform for businesses to take the pain and complexity out of making international payments. Rylan, thanks for joining us and welcome to the show.
Hi Ben, thanks for having me and thanks for the opportunity to have a chat to your listeners today.
Yeah, no problem. So Rylan, obviously COVID-19 has caused many disruptions for businesses all over the world over the past few months. Most people are obviously stuck working from home and it's caused so much volatility in foreign exchange markets over the past weeks and months. So today I wanted to give our listeners some insight into what you see happening and how they can look to manage their foreign exchange risk in their businesses. So for buyers and sellers around the world today, the process typically starts with buyers and sellers negotiating on Proforma invoices and sales contracts for the products to be supplied. And then the buyers have to look to make those international payments to their suppliers. So to start off with, can you tell me a bit about Airwallex and how it helps businesses to manage their international payments?
Yeah, sure. So Airwallex is first and foremost a technology company. We've been around for 3 or 4 years now. And what we're doing and what we're targeting is building an end-to-end financial services platform that will help businesses of all sizes to scale globally into new markets. Yep. Most of our customers, in terms of the verticals that they operate in, are across e-commerce and marketplaces, travel, education, and logistics. Most of our customer base at the moment is based out of Australia, Hong Kong, the UK, and the EU, and the US as well. But all of those customers have a global presence, and they operate mostly out of jurisdictions across Southeast Asia, like Malaysia, the Philippines, and Thailand. We have customers operating out of North Asia as well, including China, Japan, and Korea, and right throughout Europe and North America as well. So in short, what we're looking to do is have a very simple and intuitive platform that can help businesses to easily collect funds from their customers, convert it into a currency of their choosing, but also to be able to make payments to suppliers as well. So really capturing that end-to-end financial services flow. We want to make it really quick and easy for customers to quickly scale up in those new jurisdictions and to get operating really, really quickly. And to do it in a way that is really easy for them to do as well, using our modern technology. Traditionally, what we see from banking partners in when they're looking to help their customers scale into new jurisdictions is that onboarding and getting accounts even in new jurisdictions can be a very lengthy process, and involve long onboarding periods, and a lot of paper forms, that sort of thing, and we're trying to take that pain and that heartache away from businesses as well.
Absolutely. Well, that can only be a good thing. Nobody likes the paperwork. So
no, not at all.
So can you tell me what you've seen happening in foreign currency markets over the past weeks and months, and what sort of impact that's actually having on currency exchange rates?
Yeah, sure. So obviously a word that's been used a lot during COVID-19 crisis has been the word unprecedented, and that's certainly what we've seen in financial markets, but foreign exchange markets specifically. In terms of volatility, which is how frequently and how much foreign exchange prices move, we're seeing at a global level across all the different currencies, literally all-time lows in volatility through the early part of the year and in early January. And that was obviously almost unprecedented in terms of the levels of low volatility. So there was very much a low risk factor there for businesses where they were operating across and needing to convert funds. But literally within a 2-week window in the early part of March and through to mid to late-ish March, we reached levels not seen since the GFC. So we saw a very rapid spike in foreign exchange volatility. Using Aussie dollar against US dollar as an example, we saw the value of one Australian dollar fall from around 66 US cents down to 57 US cents in a very short space of time within a 2-week window. That was a more than 13% drop. And literally within a very short space of time on the other side of that, it has bounced back to around 63 US cents in that same, in a very similar period. And so it's bounced 10% back off of those lows. The impact for your listeners where they are operating across borders and across different currencies is that when you see those periods of high volatility, if they haven't had a risk management strategy in place, is that very quickly can erode any profit margin. If you are running on relatively narrow margins, 10%, 13%, it can erode that very, very quickly. So that's something that businesses need to be conscious of.
Yeah, no, there are definitely such large fluctuations in a short period of time. Businesses need to be aware of some strategies, or at least have a look into some strategies that they can implement to minimize that risk, because there are quite a lot of businesses that do work on low margin, and it's quite important to understand that. So I guess it's quite hard to answer, but I mean, how long do you expect this period of uncertainty to exist for?
Yeah, I think that's something that markets around the world have been trying to establish and trying to work out. Forecasting FX is an incredibly challenging thing to do. There are so many inputs into why a currency rate happens to move around. So that's a real challenge in terms of forecasting FX prices into the future. But what we have seen in markets is massive central bank intervention, whether it be from the US Fed, whether it be from the RBA or the Bank of England or the Bank of Canada. And they have been effectively throwing huge amounts of cash at this particular problem. And they've intervened in a size that hasn't been, again, seen before, and certainly in larger in scope than the interventions that were made through the global financial crisis back in 2008 as well. We've also obviously seen from many governments around the world fiscal intervention as well. So governments are throwing, again, cash at businesses and at individuals, trying to stabilize their respective economies. So what we've seen is that has brought some stability to markets. And certainly the volatility has dropped away probably over the last 2 to 3 weeks. Oil markets aside, as we've seen over the past week or so, there's been obviously some large fluctuations in oil markets. And I think what we will see is periods of volatility in different financial products and financial markets as we progress through this as well. But I think as markets and as economies start to open up again, which is what we're seeing at the moment, there's a lot of talk over relaxing some of these social distancing measures in lots of different jurisdictions around the world. Then markets will slowly, come back to normal over time. But it's certainly going to be here and with us for a while. Yeah,
absolutely. It's challenging times, but hopefully things start to get a bit more stable into the future. Who knows how long that will take, but it's interesting times. Can you give our listeners some typical examples of how importers and exporters are typically exposed to that foreign exchange risk in their day-to-day activities?
Yeah, sure. I can give probably a couple of different examples, one from an importer point of view and one from an exporter, just to kind of highlight how those foreign currency moves can impact on a business that's operating on both sides in a different way. So using our Australian dollar to US dollar example, and that period of high volatility that we saw a few weeks ago. So where one of your listeners has an Australian-based business, and they're importing goods from the US, so they're an Australian-based importer, importing and buying goods from a US-based exporter. So that's the example we'll talk about up front. The US-based exporter provides an invoice that's in US dollars for $10,000 US. Now, that Australian-based importer is going to need to convert Australian dollars to US dollars in order to pay that that particular invoice.
Mm-hmm.
So using our previous example, if the Australian importer converted at 66 US cents, that would cost them Australian dollars 15,150 Australian dollars thereabouts.
Mm-hmm.
Whereas at 57 cents, 2 weeks later, that would cost them actually over 17,500 Australian dollars. So
Yeah.
it would actually cost that Australian importer in Australian dollar terms close to $2,500 more to pay for that invoice, and that's the erosion of potentially of their profit margin. So that's a large impact there to that business when they start to see that Australian dollar rate in this example fall away. The opposing side to this same example would be, again, an Australian-based business, but they are exporting goods to the US.
Mm-hmm.
So you'd have a US-based importer, and they'll be looking to buy Australian goods from the Australian-based exporter. So for the purposes of simplicity, we'll assume again that that Australian-based business or Australian-based exporter is going to be the contract's going to be in US dollars, and so 10,000 US dollar equivalent. So in this scenario, the Australian-based exporter is going to need to convert back to Australian dollars the revenue that they've generated in US dollar equivalent. So in this example, at 66 cents, they're going to receive in revenue when they convert back Australian dollar 15,150, and at 57 cents, they're actually better off. They'd be receiving 17,550 in Australian dollar equivalent for that same contract. So they're actually better off. So you can see that for an Australian-based exporter in this example, a decreasing AUD USD rate is actually better for their business from a revenue perspective. Alternatively, you may find that Australian-based exporter has issued their invoice in Australian dollars. So if they'd done that, then obviously in that scenario, from a revenue perspective in Australian dollar terms, they're not at risk. And that puts the risk back onto the US-based importer because it's going to cost them more in US dollars. So at the end of the day, with a lot of this stuff, it's who ends up holding the can from a foreign exchange risk perspective in terms of who actually has to do the conversion to repatriate funds or to convert funds to make a payment. But the short kind of wrap up to this point is that regardless of whether you're in a better position because you're an importer or an exporter in terms of the trend of an exchange rate, it's all foreign exchange risk. And by not managing it, you're effectively making a bet on the exchange rate. And that can, as I mentioned earlier, forecasting those rates is exceedingly difficult. And if you're not risk managing it, then you're effectively making a bet that could go wrong for your business. It could go right, but equally, it could go wrong.
Yeah, absolutely. And it's important. I guess sometimes it's easy to keep going ahead with your day-to-day operations, assuming that things are the same. It's important to understand, like you said, who carries that risk in the currency exchange, and if it's yourself, well, then what are some things that you can do to try to minimize that, because it does have quite a big impact to a business's profit margins and their bottom line. So, so what are some of the ways that importers and exporters can actually manage their foreign exchange risk during this period of uncertainty?
Yeah, sure. Most of, I guess, the traditional way that importers and exporters would manage foreign exchange risk would be usually there is a period of time between when the contract is signed and it's agreed what is going to be paid, and when the goods are delivered and when the payment's actually due. So the way traditionally that people would manage the risk of the rate moving between the time of contract signing and the payment being due is by using a foreign exchange forward product. So what that allows you to do is to enter into a foreign exchange forward contract at the point when the original contract is signed, and to effectively lock in a rate for let's just, for an example's purpose, 30 days later, the payment's due.
Yeah.
So what you're doing by entering into a forward contract is saying, I want to lock in the rate between the US dollar invoice and how much is due in 30 days, and locking in at this point in time how much Australian dollars I need to pay to receive that equivalent amount of US dollars in 30 days time. So it's very much a risk management tool. You're not trying to beat the market or anything like that. All you're saying is, I'm locking in my rate right now, so that I know in 30 days time exactly how much Australian dollars I need to pay for that US dollars in order to pay my supplier. So obviously at the end of that 30-day period, underlying exchange rates are continually moving around, and it may have moved against you, or it may have moved for you. But at the end of the day, it's a risk management tool that gives businesses greater certainty over their cash flows into the future. So that's a very traditional way that businesses typically manage that foreign exchange risk for that period of time between contract signing and when the payment's due. I think what it's important, and we've kind of touched on it so far as well, is for businesses to be, I guess, aware of natural hedges that exist within their businesses as well. So where you may have revenue generating activities, but also costs in a specific jurisdiction and a specific currency, then utilizing cash flow management tools and transaction banking tools that allow you to better take advantage of those natural hedges that exists in a business's workflows. And what I mean by that is, rather than converting foreign denominated revenue back into your local currency and then converting it back again at a potentially different rate at a different time in the future to pay out costs, then potentially just leaving some of that revenue locally, so that you're not having to convert it back and pay fees on that, and then convert it back and be exposed to foreign exchange risk along the way. So Airwallex has a product, our global accounts product, and that can help businesses with their cash flow management, for example. So you can receive US dollars into a US dollar account that we can spin up for you at the click of a button, and then that can subsequently be used for US dollar payouts in the US, whether it be for marketing or sales or tax or whatever it happens to be. So that way, you only convert and repatriate back to your local jurisdiction what you need. There's also, I guess, another scenario, even where you've got revenue in one jurisdiction and costs in another, and then you've got your local jurisdiction, so you're working with three now. Then this particular product or cash flow management strategy as well may allow customers to again receive US dollar revenue, have it received and stored locally in a US dollar account in the US, and instead of repatriating back to your local jurisdiction and then converting into a third jurisdiction to pay out your supplier, you can go straight from US dollars into Korean won or to Japanese yen or whatever it happens to be in terms of where you're needing to pay your suppliers. So again, that kind of cuts down on your costs and reduces the risk of you needing to be converting across multiple, more than one currency, and really streamlining that cash flow management can be a key tool for customers as well. And that, I guess, brings me to our last point, is that when you do need to convert, obviously trying to make sure that you're converting at the best possible rates that you can. So at Airwallex, we're very focused on bringing the sharpest possible rates and the best possible rates that we can together for our customer base. There is margin squeeze right across the industry, but I think depending on the relationship with the business's bank, spreads can be still quite wide, and that's something that I think is a very easy win for businesses as well, is to really understand what rates they're getting executed at, and how close to the real market rate are those rates in reality. So at Airwallex, we're very, very focused on getting the best possible rate from the market, and working with the biggest banks to make sure that we're bringing the best possible rate to our customer base as well. So I think that's another key way that people can better manage that risk, is by reducing the costs of FX, and they can do that by making sure they're getting executed at a really sharp rate, and also the cash management tools and workflows that we spoke about earlier as well.
Yeah, no, that's interesting. I think in the past, a lot of these actions and a lot of these tools have been quite complex and mostly available to larger businesses, and quite hard to get set up in the beginning and start collecting or converting straight away. Whereas it sounds like Airwallex sort of gives quite an easy solution for businesses of all sizes to be, to give them the power to do all of these things and to do them well. So can you tell me a bit about the typical process that's involved for a new business or a business to get set up and using the Airwallex system?
Absolutely. So the sign-up process was really important to us. We want to make it as simple and easy to use as possible, and as streamlined as possible. It's the first interaction with one of our customers, and that onboarding and know your customer. It is a regulated area, so there are minimum requirements to get an account set up. But at the same time, we have made it as simple and easy as it possibly can. It's all online. There's no paper forms or branch visits or anything like that. And it's free to do so. So there's no setup, there's no monthly fees. The majority of our customers, where they've got a relatively simple corporate structure, can get started with their company registration number and associated details, and copies of the IDs of significant shareholders or beneficiary owners as well. So the majority of our customers that have a relatively simple corporate structure can be signed up and ready to go within 24 hours. Once the sign up is complete, then you can obviously get access to a domestic business account, but also accounts at the click of a button right throughout the US and the UK and Europe as well, without having to go through that painful process of applying for an account in each country that you might want to transact in, which is, I guess, the more common practice traditionally amongst banks, is certainly for those regional and global banks, which is, that's the other challenge as well, is that certainly once an organization is too small, I guess, for one of those global or regional banks, then it's very hard to get access to these sorts of capabilities in terms of opening accounts in these jurisdictions. But even for a business that's large, where they might want to open a new account, traditionally that would involve an onboarding process with the local bank's branch or entity in that jurisdiction. And you have to follow the onboarding process all over again, whether it's the UK, the Europe, US, Australia, Singapore, Hong Kong, it doesn't matter. You'll need to go through that onboarding process again. Whereas for us, it's, we concentrate very hard on onboarding once, and then allowing you to get access to the account structures that you need and the capabilities that you need to get into a jurisdiction and get operating as quickly as you possibly can. The additional capability that you'll have on the platform is obviously in my domain around being able to obviously instantly view currency exchange rates, being able to book conversions, very simple kind of UI, and payments as well. And then what we've got, the final product that's kind of gone live in the last quarter, it's Australia only, unfortunately at the moment, but we are looking to expand it across other jurisdictions as well, is our virtual card product. So users with just a couple of clicks can spin up a virtual Visa card and be able to use that. It's a natively multi-currency product, and can be using that to make payments all around the world if they don't want to be making either a SWIFT payment or a local payment into that jurisdiction. They get all of that access right across collecting funds into locally domiciled accounts all the way through to conversion, and we're increasing our methods of payout as well. So and we update the platform all the time. We've got a very deep roadmap of customer facing features that we want to bring to market over the coming years. And it's, as I say, all around being intuitive, easy to use, and speed as well. So yeah, that's certainly what we're focused on.
Yeah, absolutely. It's all about removing the barriers, as you say, to getting started. And sounds like you guys, your team has taken, quite a traditionally complex processes in so many ways, and just made them easy and accessible and quick to get started. So yeah, that's great to hear. Okay, great.
Absolutely.
Well, look, I appreciate your time, Rylan. I think you've given our listeners some good insight into sort of what's happening in the market today. It's definitely quite a volatile market. Businesses they need to be aware of different strategies they can put in place to minimize their risk, because yeah, it can really affect their bottom line. So really appreciate your time. Thanks for your insight, and yeah, keep up the good work.
Fantastic. Thanks to you, Ben, and thanks for your time today.
No problem. Thanks.